What if one signature could change the future of cryptocurrency in America? Not by creating a new coin, not by launching another ETF, but by finally answering a question that has haunted the crypto industry for years. What exactly is a digital asset? For over a decade, that uncertainty has created billions of dollars in lawsuits, delayed innovation, and pushed some of the biggest crypto companies overseas. Investors have watched projects rise and collapse while regulators argued over rules that were never clearly written in the first place. Now something different is happening. Donald Trump has publicly thrown his support behind the Clarity Act, a piece of legislation that many believe could become the biggest crypto law ever passed in the United States. If it succeeds, it could redefine how crypto is regulated, where companies build their businesses, and why trillions of dollars in institutional money have been waiting on the sidelines. But the biggest question isn't whether Trump supports it. The real question is, what happens next? Because if this law becomes reality, the crypto market you know today may never look the same again. For years, every major crypto company has been asking the same question. Who actually regulates digital assets? Is it the Securities and Exchange Commission? Is it the Commodity Futures Trading Commission? Or is it both? No one has had a definitive answer. That uncertainty has become one of the biggest obstacles preventing the United States from becoming the global leader in blockchain innovation. Some companies relocated overseas. Others spent hundreds of millions of dollars fighting regulators in court. Even ordinary investors were left wondering whether the assets they owned could suddenly become the target of enforcement actions. The Clarity Act promises to change all of that. Supporters believe it could finally establish clear rules for digital assets. Critics argue it may not solve every problem. But here's where things get interesting. Trump's support could dramatically increase the political momentum behind the legislation. And that raises an even bigger question. If Washington finally creates clear crypto rules, who stands to benefit the most? To understand why this moment matters, we have to go back. When Bitcoin launched in 2009, lawmakers barely noticed. It was viewed as a niche experiment created by anonymous programmers. Then Ethereum arrived. Smart contracts changed everything. Suddenly, blockchain wasn't just about digital money. It became an entirely new computing platform capable of supporting decentralized finance, NFTs, tokenized assets, stablecoins, and countless other innovations. The industry expanded faster than regulators could react. Instead of Congress writing new laws specifically for digital assets, agencies relied on decades-old financial regulations that had been designed long before blockchain technology even existed. As crypto exploded into a multi-trillion-dollar industry, confusion grew alongside it. Some tokens were labeled securities. Others were treated as commodities. Sometimes the same asset seemed to fall into both categories depending on who was speaking. Companies were forced to operate without knowing exactly which rules applied. That uncertainty became one of America's biggest competitive disadvantages. Meanwhile, countries around the world began introducing comprehensive digital asset regulations. Nations in Europe moved forward with broad crypto frameworks. Financial centers across Asia competed to attract blockchain companies. The race wasn't just about cryptocurrency anymore. It was becoming a race to dominate the financial infrastructure of the future. Many industry leaders warned that America was falling behind, not because it lacked innovation, but because it lacked clarity. And that's exactly what the Clarity Act is trying to address. The biggest idea behind the legislation is surprisingly simple. Instead of regulating every digital asset the same way, the law attempts to classify them based on how decentralized they actually are. That distinction could change everything. Imagine a startup launching a blockchain network. In its earliest stages, the founders may control most of the project. Investors are relying heavily on that central team. Under existing legal thinking, that often resembles a traditional security. But over time, If the network becomes widely distributed and no single group controls it anymore, the asset may function much more like a commodity. The Clarity Act attempts to recognize that evolution. Instead of assuming every token remains permanently locked into one category, it creates a framework that acknowledges how blockchain networks mature over time. That may sound technical, but the implications are enormous. Because once companies understand the rules, they can actually build around them. Investors gain confidence. Institutions gain certainty. Entrepreneurs know what regulators expect, and capital tends to follow certainty. History has shown that markets rarely fear regulation itself. They fear uncertainty. Clear rules often encourage more investment, not less. But that's only part of the story, because another major shift could happen behind the scenes. Here's where things become even more fascinating. The Clarity Act isn't simply about regulation, it's about competition. For years, blockchain entrepreneurs have asked themselves one difficult question. Should we build in America? Or should we launch somewhere else? Every company that leaves represents more than lost tax revenue. It means losing engineers, developers, researchers, venture capital, high-paying jobs. Entire ecosystems can grow around emerging technologies. We've seen it before with Silicon Valley. We've seen it with artificial intelligence. And now the same battle is unfolding around blockchain. Trump has repeatedly argued that America should lead the crypto industry instead of driving it away. His support for clearer digital asset regulations aligns with a broader strategy of encouraging innovation inside the United States. Supporters believe this could attract companies back, encourage new investment, strengthen America's financial leadership. But critics remain cautious. Some argue the legislation still leaves unanswered questions. Others worry implementation could become more complicated than expected. And even if Congress passes the bill, regulators will still need to interpret and enforce many of its provisions. Passing legislation is only the beginning. The real transformation comes afterward. So what actually happens if the Clarity Act becomes law? The first major change is confidence. Large financial institutions often avoid uncertainty. Pension funds, insurance companies, banks, asset managers overseeing trillions of dollars. These organizations generally prefer stable regulatory environments before making massive investments. Greater clarity lowers perceived legal risk. That alone could encourage broader institutional participation. The second change involves innovation. Developers would have clearer guidance for launching blockchain networks. Companies could spend less time worrying about lawsuits and more time building products. Entrepreneurs who previously avoided the United States might reconsider. The third shift involves competition. If America creates one of the world's most comprehensive crypto frameworks, it could become an increasingly attractive destination for blockchain businesses. More startups, more venture funding, more infrastructure, more jobs. The fourth impact could reshape traditional finance itself. Tokenization, the process of placing real-world assets like stocks, bonds, real estate, and commodities onto blockchain networks, has become one of the fastest-growing trends in finance. Major financial firms are already exploring tokenized assets because blockchain technology can make transactions faster, cheaper, and more efficient. A clearer regulatory framework could accelerate that trend. And then there's Bitcoin. Although the Clarity Act doesn't directly change Bitcoin's underlying technology, broader regulatory certainty often influences investor confidence across the entire digital asset market. If institutions become more comfortable participating in crypto, demand could expand across multiple sectors. Bitcoin, Ethereum, stablecoins, tokenized assets, blockchain infrastructure. The effects could ripple throughout the industry. But here's something many people overlook. No law guarantees higher prices. Markets still depend on economic conditions, interest rates, liquidity, global events, investor psychology. Legislation creates opportunity. It doesn't eliminate risk. That's an important distinction. History has repeatedly shown that excitement alone doesn't sustain long-term markets. Fundamentals eventually matter. The companies building real technology, the networks solving real problems, the investors thinking beyond headlines. Those are often the ones who benefit the most over time. And perhaps that's the biggest lesson of all. Because beneath every major market cycle lies a deeper transformation that few people recognize while it's happening. But here's where things get even more interesting. The Clarity Act isn't arriving in a vacuum. It comes at a time when the entire financial world is beginning to rethink how money moves. Over the past few years, some of the largest banks and asset managers on Earth have quietly invested billions of dollars into blockchain technology. They're experimenting with tokenized securities, digital payment systems, and blockchain-based settlement networks that could eventually replace processes that have existed for decades. Why? Because today's financial infrastructure is surprisingly outdated. Many stock trades still take time to settle. Cross-border payments can take days. Financial institutions often rely on multiple intermediaries to complete a single transaction. Blockchain promises something different. Near instant settlement, lower costs, greater transparency, and the ability to move value around the world 24 hours a day. That's why many analysts believe the real opportunity isn't just cryptocurrency. It's the technology underneath it. If regulatory clarity finally arrives, companies may feel far more comfortable investing in that infrastructure. Suddenly, blockchain isn't just a speculative asset class. It becomes a platform for rebuilding parts of the global financial system. And that's where the conversation becomes much bigger than Bitcoin. Imagine a future where stocks trade around the clock. Real estate ownership can be divided into digital shares that anyone can purchase. Government bonds settle in minutes instead of days. Small businesses raise capital using tokenized assets instead of traditional financing. These ideas once sounded futuristic. Today, many are already being tested. The missing ingredient has often been legal certainty. Large institutions rarely move first when the rules remain unclear. But once a clear framework exists, adoption can accelerate much faster than most people expect. We've seen this pattern before. The internet existed for years before businesses fully embraced e-commerce. Smartphones existed before mobile apps transformed daily life. Artificial intelligence developed quietly for decades before suddenly becoming one of the biggest technology stories in the world. Innovation often moves slowly, until it doesn't. Some investors believe blockchain could follow a similar path, not because prices always rise, but because adoption tends to build layer by layer until one day it feels like the technology is everywhere. If that happens, future generations may not think of blockchain as a separate industry at all. It may simply become part of everyday finance, operating quietly behind the scenes just as the internet powers much of modern life without most people ever thinking about it. Whether the Clarity Act becomes the catalyst for that transition remains to be seen. But few would argue that the conversation has reached a turning point. The debate is no longer about whether digital assets are going away. The debate is about who will write the rules that shape the next generation of global finance. The Clarity Act may ultimately be remembered as far more than another piece of legislation. It could mark the moment when cryptocurrency stopped operating in legal uncertainty and started becoming a permanent part of the global financial system. Trump's support has brought new attention to that possibility. Whether the bill passes exactly as written or evolves through Congress, the conversation has already changed. Washington is no longer debating whether digital assets matter. It's debating how they should fit into America's financial future. And that may be the biggest shift of all. The next chapter won't be written by headlines alone. It will be written by lawmakers, innovators, investors, and millions of people deciding whether blockchain technology truly represents the next evolution of finance. Years from now, historians may look back at this period and ask a simple question. Was this the moment America chose to lead the digital asset revolution? Or the moment it let someone else define the future instead? The answer may determine far more than the price of Bitcoin. It could determine who builds the financial system of the next generation.